Hi, this is Joe Hoyle, speaking to you today from the University of Richmond as the author of your financial accounting textbook. And in this chapter, we're talking about the process of producing adjusting entries and using those to produce financial statements. And in the first video, your roommate has come to you and asked a fairly interesting question. Her parents run some ice cream shops, and they have kept great records. They have used journal entries apparently, they have used T accounts, they have ledger accounts, and then after they do all of that, they turn around and hire an accountant. And your roommate is mystified as to why they spend the money after they've kept all the records. Well, here's one way to answer the question. They have done the mechanical work. They have made the journal entries, they know the debits, they know the credits. But many times you need an accountant to come in to turn those records into financial statements. So what will the accountant do if the accountant comes in to help your roommate's parents? The accountant will probably take the ledger accounts, all of the balances, rent expense, cash, salary expense, and so on, and make a trial balance. A trial balance is a list of every account and indicating whether it's a debit or a credit. And the accountant then will do a couple of very important things. One is that the accountant will look for any account that might need an adjusting entry. And an adjusting entry is a change in an account, not because of a transaction, but because of the passage of time. Over time, rent expense grows larger. That needs an adjusting entry. It's not a transaction, it's a passage of time. Salary expense may need adjusting. And the roommate's company or the roommate's parents' company may have those expenses. The accountant will come in and say, this probably needs to be adjusted so that it's correct at the end of the year. This balance needs to be adjusted to make sure it's fairly presented on the financial statements. Also, the accountant will look at each account to see if there's any account that might have been done incorrectly. Now, the roommate's parents have done a great job of keeping the records, but mistakes always happen. That's just human nature. So the accountant will look to see, is there anything that looks wrong? Is there anything that looks like it's not presented fairly according to U.S. GAAP? And an accountant through years of training will get very good at spotting possible problems and then fixing those problems. So the accountant will come in and make adjusting entries because of time and also fix any account that's not presented according to U.S. Generally Accepted Accounting Principles, U.S. GAAP. Once all of the accounts have been updated in a proper way, the accountant can take those and produce financial statements. The income statement's done first, the statement of retained earnings is done second, the balance sheet's done third, and then the statement of cash flows is done last. And you have a set of financial statements that they can give to the government, they can give to other stockholders, they can give to bankers, or they can give to anyone who wants to know about that company. So this chapter talks a lot about that process of creating adjusting entries because of the passage of time. We typically talk about 4 adjusting entries that the accountant will look at most carefully. Prepaid expenses. In a prepaid expense, you pay for the asset first, and it gradually becomes an expense as time passes. You pay for rent in advance, and it goes in as a prepaid rent asset. But over time, the future value becomes a past value, and it changes to a rent expense. That is handled through an adjusting entry. We talk about accrued expenses. Many companies have accrued expenses. They are expenses that grow slowly over time. Salary grows every day. Interest grows every day. Those are accrued expenses, and since they grow so slowly, they're often not recorded in the normal journal entry process. The accountant comes in and looks for an accrued expense. Do you owe any interest expense that you've not recorded? Do you owe any rent that you've not recorded? Do you owe any salary that you've not recorded? Those are recorded as adjusting entries so that the financial statements are then fairly presented. We have accrued revenues. Accrued revenues are revenues that grow very slowly also. Instead of being the person who rents the building, you're the person who owns the building that's being rented. The rent grows very slowly, but for you, it's a rent revenue. The accountant looks for any accrued revenues that have grown slowly and need to be recorded. You can also have unearned revenues, where someone gives you money in advance. A newspaper, for example, will get money before it delivers the newspapers. When it first gets that money, it records that as an unearned revenue, and then when the work is substantially completed, the accountant comes in and adjusts that to move it to a regular earned revenue. So the accountant records the adjusting entries to update any account that has changed because of the passage of time. Tends to be four types: prepaid expenses, accrued expenses, accrued revenues, and unearned revenues. And what you're doing then is you're taking the financial information that your roommate's parents have kept so meticulously, and you're turning it in to fairly presented financial statements so that outside decision makers can get a fair representation of that company and make decisions. It's all about conveying the information so that good decisions can be made. Because when that happens, everyone benefits. Have a great day. This is Joe Hoyle at the University of Richmond.